So we transition now from Europe to emerging markets. We're very fortunate to have a great panel. I will not introduce them in detail. Their bios are in the program. But we're very fortunate to have Emilio Ocampo from the Universidad del Centro de Estudios Macroeconómicos de Argentina, Juan Pablo Nicolini from the Federal Reserve Bank of Minneapolis and the Universidad de Tela, Zhiguo He from Stanford University, and Ross Levine from Stanford University. And so we will begin with Emilio Ocampo, please.
Thank you. Thank you for the organizers for inviting me. Frankly, after listening to Condi Rice's presentation today and Yuri Korodnichenko's presentations, I feel that the subject matter I'm going to be talking about might not be as, globally relevant. But let me start with this graph. I'm going to talk about dollarization. I'm going to talk about Argentina. I'm reminded of Lionel Robbins' preface of Constantino Bresciani Turrione's account of the German hyperinflation. He said, in economics, sometimes you can learn a lot from the pathological cases. And clearly, Argentina is a pathological case. And in this graph, we have two axes. The horizontal axis, what we have is the number of years in the last 25 years. 25 years is usually considered a generation. The number of years in which GDP per capita had a negative value, the growth in GDP per capita. So, and then on the vertical axis, we have the number of years in the last 25 years during which a country was among the countries, the top 10% in global inflation rates, the top decile. And so what we plot here is all the emerging market economies. And as you can see, there's an outlier there. There's a group of countries that have had very high inflation, and they also had a large number of years with negative growth. And Argentina figures prominently there, together with countries like Venezuela, Zimbabwe, etc. The interesting thing is that none of these countries have the level of education, GDP per capita, institutional development that Argentina has. So one has to wonder what Argentina is doing there. Interestingly, if we go back to an earlier period, and I use here the period 1966 to 1990, well, guess what? Argentina was back then in this same group. What happened in between? We had 10 years of convertibility, and during the 10 years of convertibility, the number of years Argentina was among the countries with the highest inflation rate went to zero, because we had one of the lowest inflation rates in the world. The other interesting point to make is that when we go back to the 1966-1990 period, the countries that were surrounding Argentina included Brazil, Chile, Uruguay, Israel. None of those countries are in the group today. So the rest of Argentina's neighbors were able to escape from this kind of stagflation trap. Now, when Finn Kydland gave his Nobel lecture, he devoted a couple of pages to Argentina, and he said, and he coined the term time inconsistency disease. And he said Argentina is the paradigmatic case of time inconsistency disease. This is the pathology. And the pathology is that the short term always prevails, and the policymakers always place more importance on the short term than anything else. And this affects monetary policy, and it affects fiscal policy. And Kydland said, well, how do you cure yourself? If you have time inconsistency disease, is there a cure? He said, well, there has to be one, but it's not easy to recover credibility when you have this problem. And we all know that without credibility, it's impossible to be able to bring inflation down. Now, what is the cure to time inconsistency disease when you suffer from another type of phenomenon, which is called institutional anomie? Well, when you have time inconsistency disease, and you have acute institutional anomie, you find yourself in a very difficult spot. And what is institutional anomie? The term anomie comes from sociology. Durkheim was the first to introduce it. But there's an Argentine jurist called Carlos Nino, which in the 90s coined the term to define a state that basically doesn't obey the law. The laws that the state actually promulgates are not obeyed by the executive. So the executive either ignores, abrogates, modifies the laws at will when it suits it. So if there is a short-term consideration that requires the executive to violate the law, it does. Because the Supreme Court doesn't act, and the legislative power is basically under its control. So we have a situation where separation of powers, even though it's in the Constitution, doesn't really work because the Supreme Court and Congress are enablers of this kind of misbehavior by the executive. So the problem you have when you have institutional anomie is that it's impossible to have an effective commitment device under local jurisdiction. And this disease, because it's also a disease, is very prevalent in countries that have endemic populism. Because one of the aspects of populism is about undermining the quality of institutions and undermining the separation of powers. So in a way, we can say that time inconsistency disease is the other side of the coin to institutional anomie. If you have very high institutional anomie, then you don't have any tools to neutralize time inconsistency. And the way it works with populism is, we all know, and we have Sebastian Edwards here, he wrote with Rudy Dornbusch that classic study on populism. Populism is about being time inconsistent. It's about promoting consumption at the cost of investment. So policy time inconsistency is an essence of populism. And institutional anomie is an essence of populism as well, because when they get to power, populist leaders usually try to eliminate any constraint on their power. So this is a sort of a vicious cycle. And we have a number of different commitment devices that we could use to somehow treat the time inconsistency. And I divided them here between formal and informal. Formal are established by law, and you can have them internal or external. If you have an external commitment device by law, that means that you have an international agreement or something like that. For example, Bretton Woods, you could consider it a commitment device based on an agreement. The gold standard was also a commitment device. Well, what is the possibility of having any of these commitment devices work in a country like Argentina that has acute institutional anomie? Well, it's very difficult because Argentina has, for example, no reputation and no access to the markets today. Market discipline doesn't work. We have voters who are time inconsistent themselves. So voters do not provide any limit to the misbehavior of the government. And the idea that you can have a central bank that is independent is rendered mute by the fact that you have institutional anomie, and the executive doesn't care whether the law says, oh, we have a central bank that is independent. Well, in practice, that central bank is not independent. So basically, we're left with no commitment devices that we can use to gain credibility. And this is a typical example of what I mean by institutional anomie in a context that you will understand well. There's a study of de jure central bank independence. So what you see here is this index for Argentina since the 1960s and for the G7 countries. And you see that in theory, on paper, Argentina had an independent central bank, or at least it was more independent than the central banks of the G7 countries. But in the 62 years that includes this sample, in 49 of them, Argentina was among the 10% countries with the highest inflation rate in the world. So the idea that we had an independent central bank de jure, so the law said that we had an independent central bank with a mandate for price stability, and they obviously did not fulfill that mandate. If we look at past stabilization plans in Argentina, we go back to the 60s. We had the Minister of Economy making a commitment, for example, to an exchange rate regime. And let me show you what happened. They lasted 3 years at most. When the Austral plan came, the minister's assurance was not enough, so the president issued a decree, but that system didn't last very long. And then we had convertibility, We had convertibility, that did last. We had a law by Congress, but in the end, the politicians were able to reverse convertibility very quickly in a couple of weeks. Now, we're trying a new experiment in Argentina. And now we have a crawling peg with a 2% adjustment every month. Unfortunately, the inflation rate is running at 9% per month, so we're going to see what happens. Today, the president of Argentina came out with a statement saying, don't worry, the real exchange rate has not appreciated so much. It's the right real exchange rate for Argentina. So we'll see whether this assurance is enough to gain credibility. And the way I frame it is the credibility of any plan depends on what people expect that plan to do in the future, whether there's a probability of reversal. Obviously, the highest the probability of reversal, the lowest the credibility. And so when you have time inconsistency disease and you have acute institutional anomie, you're at a very unfavorable point. You cannot get away from that. You cannot go back to a spot where you can generate credibility, all right? And the cost of reversing any reform is the critical point. People will believe in a plan if they think that it's going to be costly for a politician to reverse it. And that's why dollarization offers a way out of this conundrum, because it can push the economy into a situation where the cost of reversal is very high. I was listening to the conversation about Europe and the issue about exit and whether exit is a possibility or not. Alan Kuckerman, many years ago, said something that is very true. The laws don't matter. It doesn't matter what you decide by law. What really matters is the political cost of reversal. And the example of Ecuador in that regard is very strong. You know, this is from the BBC. It's an article about Ecuador. And it says, nobody discusses dollarization in Ecuador anymore. Because the people remember that when the Sucre was there, they had inflation and they were losing purchasing power, etc. And so the reality of the matter that Ecuador had a lot of problems. But if you look at the inflation rate of Ecuador in the last 5 years, it has been much lower than the US. So you didn't see that spike that you see in the US and other Latin American countries in Ecuador. Ecuador has very stable prices. It has a lot of problems. You know, you can't expect dollarization to solve all problems. It can solve one problem, which is inflation. So 85% of Ecuadorians support the dollar. So when you had a populist politician like Correa come and try to reverse dollarization, he couldn't because the dollar was more popular than he was. So dollarization can break the vicious cycle of acute institutional anomie and time inconsistency disease. And I'm going to quote Friedman, since we're going to talk about Friedman later, but in 1973, he gave a testimony to Congress, and not a lot of people are familiar with this. And in that testimony, he referred specifically to Argentina. He said, he was very critical of US policy, but he said Argentine policy is so much worse that they would do well to adopt US monetary policy. So you can look at this statement, you can find it. But so we're going back to Friedman, 1973, US had an annual inflation rate of 6.5% back then, and Argentina around 65%. Argentina's inflation rate today is close to 300% a year. So with that, I close my presentation. Thank you.
Okay, thank you very much for the invitation. It's a pleasure to be here. I'm Argentinian also, so I'm fascinated by inflation, just by personal experience. To explicitly say this, does not, what I said does not reflect the views of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So essentially, I took two of the bullets of the description of what the conference was about, is how to get back and stay on track, and how to reduce inflation rate without slowing down economic growth. So I'm basically going to be talking about lessons from Latin America. This is regrettably, Latin America is an amazing lab. If you're thinking about inflation, almost everything has happened there in the last 60 years. So you might watch. And I'm a little bit surprised that sometimes the policy debate here, it does not use the richness of experiments, regrettable experiments that we have around the world. So I'm going to do a very brief history of Latin American inflation. Here, actually, it's the 10 largest countries of South America plus Mexico. I'm not going to have any country from Central America. And basically, I'm going to try to give you in very, very few minutes 60 years of history, and I'm going to claim that one can think of 4 different stages. One is managing chronic but moderate inflation relative to what happened afterwards. And then right after the end of the Bretton Woods, we have a couple of decades with hyperinflation and stabilization. And then it followed a decade of, I'm going to call it the conquest of inflation, and then basically the last 15 years of a lesson learned, except for 2 failed students, which have already been mentioned. So, and then I'm going to focus on the 2019-2023 period for those 9 countries that passed, not for the 2 failed students, in order to get to the point of what we want to discuss in the conference. But my conclusion is going to be that for those 9 that passed, maybe monetary policy never got off track. And then if I have time, and then I'm going to talk about a little bit about all this experience. In all these years, there were a lot of attempts to reduce inflation, many of them successful, at least temporary, and then we can see there whether, and essentially what you see there is that many of these inflation episodes were achieved without any output losses. So I'm going to give you very briefly a review. So basically, I'm going to be talking about yearly inflation rates for these 11 countries from 1960 to 2019 first. First, I'm going to give you the whole picture, and then I'm going to concentrate on the last few years. So how do I do that in countries that had these levels of hyperinflations in different years? Well, basically, I'm going to say, okay, I'm going to just plot whatever the inflation rate or a certain number, they're going to call it the max. So just to give you a picture of what happened. So basically what I'm going to plot now is inflation for all this period for these 11 countries. I'm going to also have the US, but I'm going to put a cap there. The first one is going to be 150 per year. I'm going to say after that, that's too high. And this is what you get. Well, yeah, my colleague Ellen McGrath said, that's a horrible picture. And I said, well, it depends what you want to do with it. So basically, I want to claim that from here you can get these 4 different stages. So you get a first stage, which is basically the Bretton Woods period, in which you see there are a couple of countries with inflations that are high there, but most of them are below 30%. And the US is the black line below. It's actually, some countries are very close to like the US. Then in 74, the things start going up. The cap is actually binding for many of the countries, and the US actually becomes like the lower envelope of Latin America up to the early 80s, in which the US goes down and Latin America keeps on going up. But then, after 1994, there is a huge drop in inflation rates, a couple of spikes still there. And then after 2004, except for those 2 crazy countries, Argentina and Venezuela, there's a lot of convergence. So this is a Hollywood story for these 9 countries. Now I'm zooming in a little bit, so I'm putting a cap only at 30, so you can actually see that up to the 80s, the US still like at the bottom of the distribution, but then there's a big divergence there. but then an amazing convergence after 2004. Okay, so let me put it in a different way. Now I'm going to give you frequency distributions. So I'm going to put on the horizontal axis some bins. So the first bin is below 5%. I'm going to say that's an amazing inflation rate. 5 to 10 is good, still one digit. 10 to 40, not good. And then 40 to 100, and then more than 100. So this is the first period. This is the Bretton Woods period. Then this is how the distribution moves to the second period, in which basically now very few observations in the good region, and then the stabilization, and then the lesson learned. But two of them fails. If I remove the two that fail, this is what you had in 2004. So this is the sense in which this is a Hollywood story. So now let's focus on that period after 2004, and then focus on the 2020-23 to see what we learned from the monetary policies of these nine good students. So this is monthly inflation from January 2020 to 2023. And again, the black solid line is the US. So inflation went up, it came down. It was a little bit higher for Uruguay. That's the one outlier in the beginning. But essentially, I would say this is proof that inflation has been conquered in these 9 countries, and that it's been behaving pretty much like other countries. Let me emphasize the red one, because the red one is the one that goes really higher. That's Chile. That's what I would call, I'm not sure Sebastian is going to agree with me, but I'm going to call the poster child of good monetary policy in the region. Still is the one that got the highest inflation, and I want to emphasize that. We're going to go back to some of the points that Yuri did in the previous session. So at least 7 of these 9 countries have explicit inflation targets. There I show you inflation, but some countries have higher inflation target than the US. Actually, the highest in 2023, Uruguay has a 4.5, Peru has 2%, Bolivia and Ecuador don't have any, but then I chose 2% for them. So now what I'm going to plot is inflation as a deviation from the target, not inflation. And then again, the US is the black solid line. You have some countries that were stabilizing during the 90s. Those are the first 2 that you see on the left. But then you see that when you measure that as deviation from the target, already by 2015, the US is not distinguishable from the rest of the sample. To put it a little bit more clearly, if you now take from 2002, what I'm doing now in red is I'm taking the average for all these 9 countries. For every year, I take the standard deviations, and then I put one standard deviation band above and below, okay? And then the black dark one is the black solid, black is typically dark. The black solid line is the US. And as you see, it's pretty much in there, and actually when it is not, after 2014, is because the US is actually below the target. But when you look at the lower interval of the standard deviation, it's essentially touching 0, except for 2 periods, and I want to emphasize that for the red lines, the 2022 and the 2008 periods are almost identical. These are periods of very high commodity prices. Many of those countries are commodity producers and exporters in sizable amounts of GDP. Chile is again, the poster child for that. Price of copper goes up 4 times, inflation in Chile goes up. It's not only because of the usual headline versus core, it's also because it produces that commodity. And those are brutal shocks. But again, as you see, both in 2008 and 2009, in 2022, inflation rate came down quickly as in both cases. So did monetary policy get off track in the region? Well, so now what I'm going to do, I'm going to give you inflation minus the policy rate. So if the coefficient on the Taylor rule would be 1, this wouldn't move. Okay, if it's larger than 1, it should go down. Well, now it didn't. These are, now I don't have all the countries. I have the countries that are doing inflation targeting here. Again, the black solid line is the US, and the others are the Latin American countries. So the fact that all the Latin American countries, the curve starts going down, means they started tightening way before. So the US lagged a little bit? Yeah, it did. We did. But we're back on track. But again, maybe the Latin American countries didn't get off track. Now let me then just finish in the last 2 minutes with I'm going to isolate episodes of inflation stabilization from 1960 till now in Latin America. I'm going to bring the episodes in which inflation peaks up at values between 13 and 150%. Actually, there are only 2 of them, above 60%. I'm going to set the year of the highest inflation equal to 0, and then I'm going to show you output 2 years before and 6 years after. And I'm going to set the level of output equal to 100 of the period 0, so we can compare the evolution of all those. So for example, this is for the US, okay? In 1980, inflation was about almost 14%, and then it came down, and then I'm plotting the black solid line is GDP, and I'm making it equal to 100 in 1980. So what you see, that recession in 1982 is what people call the Volcker recession. So I'm going to take this one, I'm going to put it together with another 16 episodes in the Latin America from all this laboratory that we gave to the world for free. And this is what you have. So you see the black line there is the one in the US, and there's actually 3 or 4 episodes in which the output is even lower in the first year than in the US, but there's actually no other episode in which output is as bad as it was in the US in '82. What can you do with 16 points? Not much of econometrics, but you can do a plot. This is what I've done. So actually, I put this in the first slide. So my conclusions are, for those that passed, these are 9 out of the 11 that are the Hollywood part of the story. Maybe monetary policy never got off track. Brutal shock, as COVID was for the US, a massive reallocation shock. Inflation goes up and then it comes down, as long as you keep monetary policy on track. And then several cases where inflation was reduced without output losses might teach us something about how to do it. Thanks.
Thanks a lot for having me here. I was hesitating what we're going to talk about, and I feel like probably people here more interested in where are we now. We means China. And also very important to clarify that if anything that, I'm a bit embarrassed just talking right after these 2 high inflation scenario, because at this time in China, the deflation is really bugging the economy there. And I will not touch on that because it seems like deflation is something that we already been tacking on, although there's no easy solution either. So next slide. Oh, I will control myself. So I want to kind of emphasize one thing, which is I believe that Nicolò mentioned that the so-called independence. Now, for China, legally, they're not. It's not independent with the execution branch. So it is just one of the 26 ministerial level of the state council. A lot of times when we talk about independence, it really means that the PBC, the People's Bank of China, is independent of the Ministry of Finance. So as long as it's independent with the fiscal policy, then largely that when I was educated there, just largely viewed as independence. And it's interesting to notice that in the past several days, I read the news that some Trump advisors argue that the president should be consulted on interest rate decisions. So in some sense, there's echoing a little bit. Policy objectives are a lot. It's like really, really a lot. Even under the Zhou Xiaochuan was the one really moved the PBC from a very, very much like a bureaucratic agency to a part where when you get in, talk to the people, you feel like a lot of ideas and the goals and the mechanisms are very similar to what I learned here. Okay, so that's Zhou Xiaochuan was the former president, governor. Even under his reign, there's lots of goals. It's not like here, it's very clear. So it's like recently when the Beijing tried to attack the COVID, every single time that you read the news, it's always like not only, but also while still ultimately achieving. The decision-making process is, there are several tools you needed to ask from the State Council. As a result, that all the members in the PBC will say that unless it's necessary, they typically do not use these tools. However, there are several, actually, they don't need to consult to the top, so they can decide immediately. And I will show you that indeed, these are the tools that they use a lot. So first of all, just to talk about something that you're probably familiar with, or the so-called open market operation. In China, I was surprised that I perhaps like 10 years ago, I went back to China, understanding all these things here, and then talk to the people there, and the open market operation in their mind is very similar to what we learned. So there's a repurchase agreement, there's a central bank bill, outright bond transactions was recently proposed as a one way to attack some QE transaction, a monetary transmission issue. However, that I want to just tell you that a repurchase agreement still is the one that actively used. I will show you the recent volume change on that. Central bank bill is not used at all now. Was very, very important when we have a lot of reserve. This is a foreign reserve caused this monetary base, but nowadays we do not use it. However, that it's extremely useful in the Hong Kong dollar that I will touch on, because the currency and the monetary policy, it's just two legs. All right. So this is the thing that nowadays that PBC really use a lot. The one that it's like the major tool is so-called MLF. It's a medium-term lending facility. It's basically, if the banks have high-quality bonds, and then as a collateral, then you can release the liquidity into the system. As you can see, the outstanding balance is also big, and mostly is recently raised. So I will show you soon. So basically, the MLF is the one that they were using. What's interesting about the MLF is that basically PBC set the rate, and that rate is linked to this so-called prime loan rate. That's the loan rate that used to set the mortgage rate. Okay, so if you think about the housing, etc., all the things, so that's the transmission that in China is doing. So this slide is just telling you that one thing that I feel very, very interesting, and it's also perhaps take many, many years to resolve. So you know that the PBC, as I was explaining, that the way it works is very similar to the US, but it's on the short side. It's on daily rate side. Like if you talk about a daily rate, like all these bond transactions, I have so many friends, like, they actually know a lot more than me in terms of like taking advantage of this arbitrage, etc. This is really the blue part, which is like the PBC set the 7-day repo rate. Then this is a heavily traded product called a DR07. And then you get to the monetary market immediately. So every day people trade on that. That kind of rates is kind of detached a lot from the real side of the rates that we typically use. It's the MLF rate, then the link to the LPR, that's the long prime rate that we'll talk about, then the credit market. But fundamentally, it's because that the banks that are, even though that there are kind of like a conglomerate, let's say Bank of China or some other ICBC, industrial commercial banks, there are two departments. One is the monetary side where they do bond trading, etc., and the other is the lending part. Unfortunately, they do not talk to each other that much, and also the funding side, it's kind of clogged. So that's the part that it's kind of an interesting part that on one side, extremely market-driven, on the other side, it's still kind of slow. Okay, so this is the RRR. This is a very important part of the monetary policy still nowadays. It's the reserve requirement ratio. And recently, you will see that, I don't see, I was putting a little bit of the circle here, but it disappeared somehow. This is the basically recent time when this is the IRR dramatic drop from here that just reflect the policy stance. This is the most important policy tool. This is the one that I was talking about. When you change this part, you need to get the state council approval. Okay, so it's kind of like slow. But this is the operated daily. I just plotted in the monthly. But you can see that the reverse repo, it's the, I can tell you, reverse repo is exactly opposite to the US reverse repo. Just because in China, we view central bank is the most important one. So when you do repo, it's just either side. So we call the other side of the US reverse repo as our repo. Anyway, it's basically releasing liquidity. And this is the part, releasing quite a bit. You can see that from the past. This is the interest rates that you can see. This is really the MLFR rate. This is LPR rate linked to the MLFR. So basically, it's policy rate. You can view that. And you go see that it's compared to the US, the policy rate, China seems to be not to do that much. And imagine, think about the background, is that we do not care about the inflation. If anything, we want to fight against the deflation. So why don't you just, cut to zero? This is because Beijing has to worry about the CNY currency part. So this is the plot just showing you that nowadays the CNH, that's the CNY, overseas CNY in Hong Kong. It's a very active market now. You can see the growth, and this is the real thing, which is that, what I plot is the onshore versus the offshore price differential. And if you see a big negative blue thing, this means that China has a depreciation pressure. Just the economic slowdown, so the currency inside the country is actually, look more expensive than the outside, because the outside people feel like, the CNH should depreciate. What's important is to tell you that around the time of 2016, 2015, if you remember the dramatic reform, and you can see that a big depreciation pressure. And I wanted to put it down is this HIBOR overnight. During that time, when the PBC fight against these pressure, or hedge funds, blah, 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 they figure out many, many different tools, and they were very proud of it. One of them is so-called overnight rate. So if you want to, you want to short on CNH, the way you do it, you have to borrow and sell, right? And then, PBC is still controlling the borrowing rate. You can see the borrowing rate at some point is 80% per year. So let me just tell you that one thing, this is good that I remember what I want to say. The one thing is, so first of all, is that China, you can see that on the monetary policy side already did a lot. So this is what I wanted to tell you, that the PBC team is the most international team. And I'm very glad that, recently I talked to one of the deputy governor who holds a PhD from UT Austin, actually, the finance PhD. So this is the most, but it's really amazing given the entire, other teams. It seems like, as we heard, like there's some de-risk or decoupling going on now. The second point is that a lot of people, when they say that, China policy, etc., they are thinking not just the monetary policy. In their mind is fiscal. They want to see something like in 2009. And I myself, my own stand, humble stand, is that they should not do it at this point, just because that, often the time we know is the fiscal policy often have a very, very long run negative overhang effect, while the monetary policy, maybe it's less effective, but it's very benign. In a world where it's a lot of uncertainty, maybe it is the best thing to do a little bit of benign things. Okay. Thank you.
While this is coming up, I want to thank the organizers, sort of. So I was asked to discuss monetary policy in emerging markets and developing economies. So there's about 150 of those. So I decided that I would choose one theme, and it's going to essentially be what the International Monetary Fund's view has been about monetary policy, their views of why it's been successful, and then I'm going to critique that view. And my critique is going to relate to a book that I wrote 15 years ago, but Professor Skinner is going to talk about this in much greater detail in the next panel. So this has to do with central bank independence. So the big picture here, in short order for many countries, is that many central banks, including emerging market and developing economies, reduced interest rates, expansionary monetary policy in response to COVID, inflation rose, and in response, central banks increased interest rates, tightened monetary policy, and inflation fell. And I'll give just a few graphs to illustrate that. One of the interesting things that I think is different, or the IMF and many institutions suggest is different, is that many developing economies were earlier than, for example, the US and Europe in tightening monetary policy in response to the increases in inflation. And you could see this, the two curves of more aggressive economies that are in this graph are Chile and Brazil. And you can see that the real rates as well, some of those took a long time to become positive. Here it is in terms of headline inflation. Inflation goes up, and as we saw in the last graph, there's the tightening and it comes down. One of the interesting things, and again, this is a key feature of the International Monetary Fund's assessment, is that inflationary expectations didn't change very much during this period. And the IMF interprets this as a signal that central bank independence, which had been won over the earlier decades, was therefore very effective in this period at keeping inflationary expectations anchored so that monetary policy could first be expansionary and then contractionary without it having the type of depressive effects that it might have in other circumstances. There are exceptions to this. Turkey is a pretty remarkable exception, and I chose Turkey because Argentina and Venezuela are even bigger exceptions, but they've already been covered. And so you can see here that monetary policy or inflation reaches extraordinarily high levels, and even as inflation is going past 40% a year, the president is arguing that the way to fight this is with lower interest rates. Ultimately, Erdogan gets elected, and that's when interest rates start to rise. But if you'll notice here that the interest rates, even though they've reached 50%, are still negative. Okay, so that's sort of the basic pattern. There are many exceptions that I can go into, but true to form, I just want to be irritating. So the IMF's explanation, and this is articulated by the managing director in March of 2024, is that it's sort of a central bank independence plus. and this is that if you give the central bank a very, very explicit target, especially a numerical target, whether it's 2% inflation or 4% inflation, whatever, and you give the central bank clear tools in order to achieve that target, and you give the central bank sufficient independence and budgetary independence, it can go out and achieve that target. The plus part is that there are, of course, some qualifications, and this came up in the earlier discussions, and those qualifications are that you can't have fiscal policy that is so strong that it's going to push the central bank to engage in excessive monetary policy. And so this is a fiscal dependence argument. This has been a part of the IMF lore for easy 40 years and probably longer. There's been an amendment to the central bank plus argument, and that's sound bank regulation. And you need sound bank regulation because if the banking system is exploding, there's going to be calls for the central bank to ease credit in order to deal with that crisis. This all makes pretty good sense. A cynical view might suggest that if there are no fiscal pressures for excessive monetary policy and no financial pressures for excessive monetary policy, do you really need an independent central bank in order to have not excessive monetary policy? But let's put that aside. Okay, I want to go back to this issue of what it takes to have effective central bank independence. You need a clear delegation and designation of responsibility. I'm not articulating this. This is the IMF argument. There are clear goals, especially numerical targets, and tools to achieve that, and transparent communication and assessment. Now, the assessment is pretty easy if you're just thinking about you, central bank, go out and get moderate inflation, 2%, 3%, whatever. Okay, a taxi cab driver can figure out whether the central bank is doing a pretty good job. Okay, pretty easy to assess. Okay, all of these things seem to work. I'm just going to go by the IMF's assessment. The issue here is that most central banks also do bank supervision and regulation. And indeed, what the managing director and IMF research tells us is that actually sound supervision and regulation is essential for effective monetary policy. So then the question is, can an independent central bank, under the criteria that I outlined, or that the IMF outlines, produce effective bank supervision and regulation? So the simple issue here is that out of all of the things that a government does, we're going to carve out monetary policy. This has been it. This has been the tradition. You stick this in an independent central bank, say, here's a numerical target, here are the tools, go out and get this. Okay, and again, we got the delegation, the clear goals, numerical, transparent communication, assessment. The issue here is that two out of three of these crucial features do not apply to bank regulation and supervision. I would like to see somebody write down clear goals, numerical targets, and tools to achieve those targets for effective bank supervision and regulation. Okay. I am pretty sure that no central bank has done that. No government has done that and then issued it to the central bank. And so that's sort of one leg of what it takes to have an effective independent entity take over from the government to do something as important as supervision and regulation. How about transparent communication and assessment? I don't know, choose your favorite central bank. Is it doing a good job or a bad job on supervision and regulation? Can the public make that assessment? I would say no way. We can't define what it is. How are we going to measure it? We might measure it by it doesn't fail, but we don't really mean that, because if we really didn't want the banking system to fail, we can do that. So that's not what is after. They're after an efficient allocation of resources from the financial system with a reasonable degree, whatever that is, of financial stability. The financial system is incredibly important, not just because it doesn't fail. The financial system allocates capital. I could change that sentence and say the financial system plays a remarkably large role in allocating economic opportunities, and hence economic growth and all of the rest. So getting effective supervision and regulation right is an unbelievably complicated task. It seems very difficult to assess whether the central bank is doing it well, and very difficult to give the central bank marching orders. And the IMF is telling me from its research that that is what is necessary in order to both do effective monetary policy and presumably do effective something else. So my concern here is that besides being very important for long-run growth and economic stability, central banks themselves are not well structured to deliver sound supervision and regulation, nor are they necessarily well structured in order to act in the best interest of the public. Central bankers are unelected. If they're independent, they're largely unaccountable. And in the case of financial supervision and regulation, they're largely unmonitorable because we don't have the information. And while it may be really good sense to stick monetary policy in there because it can be clearly defined, not so clear when it comes to bank supervision and regulation, which is not only independently important, but the IMF tells me is also very important for the effectiveness of monetary policy.
Thank you, Ross, and thank you to all of our presenters. I'm going to use my chair's privilege to make a comment and then ask a question. So the first comment I would just make is a generalization of the data that Juan Pablo Nicolini showed us, which is the secular convergence of inflation in Latin America. That extends much beyond Latin America. If you look at the emerging market and developing economies, I'm sure you know this fact, but beyond Latin America, post-1994, in 1994, the average inflation rate in emerging market and developing economies was on the order of 100%. And by 2018, it's in the low to mid single digits. And to just connect that to your point about the potential to disinflate without output losses, it's also the fact that there's a secular increase in the growth rate, average growth rate across emerging market and developing economies post-1994. So pre-1994, emerging market and developing economies are growing at 3.5% per year. Post-1994, up until COVID, it's 5.5% per year. Now, there are lots of other reforms that are going on at the same time, and Anusha Char and I talked about this in our Journal of Economic Perspectives paper in August 2021. But it's just interesting to note that this Latin American phenomenon that you document is a more general phenomenon across the emerging and developing world. My question for Ross before I open it to the floor, and we'll take a bunch of questions and then we'll let the presenters respond, is you criticize the lack of transparent regulatory targets. I just wonder what your view is about capital ratios for globally systemic important banks, and if that does not count in your view as being a clear and transparent target. So let's take a range of questions, and we'll give Ross and others a chance to respond to the questions. Yes, Michael Bordo.
I have a question for the Argentinians on the panel. So like 20 years ago, I wrote papers with Finn Kidlin and Hugh Rockoff and Carlos Vague about Argentina was a big player in those papers. And so in the 19th century, the gold standard was a commitment mechanism, which actually did work pretty well. And it acted as a good housekeeping seal of approval in basically determining whether emerging markets could obtain foreign capital, which they needed for the development. And in the Argentine case, in the latter very end of the 19th, this actually worked. Okay, it worked up until the year 1890 crisis and then afterwards. And since then, it didn't. Okay, so my question is, and Emilio sort of got at this, but why is that? Like, why has Argentina, and this is a huge question, why has it been such a problem? Okay.
Paolo Sapienza is next, and then I would ask the presenters to keep track of all these questions. So we're going to go Paolo Sapienza, Michael Boskin and Sebastian Edwards, and then we'll come back to the left side of the room. So please be brief with your questions.
Yeah, so I'm Paola Sapienza. I have a question for Ross. It's true, though, that you can evaluate, I mean, at least academic can, the quality of regulation ex post. And I wonder why the emphasis has always been on independence from government rather than independence from the banking system, which is a really big, especially big issue in many countries, developing countries, but certainly not even here and elsewhere. So that should be done more often than thinking about the other type of independence.
Okay. Michael Boskin, Sebastian Edwards, and then we'll give the presenters a chance to respond.
Thanks. Three real quick questions based on my own personal experience. First to Ross, when I was CA chair, and I think John was still there, we considered during the S&L crisis restructuring regulation and consolidating the 4 regulatory agencies in the US. The Fed was violently opposed, saying they absolutely needed to maintain that authority to conduct monetary policy. Didn't work so well in 2008, apparently. But aside from that, I wasn't quite sure whether you're saying that you wanted to separate out bank supervision and regulation to another agency, or what? I wasn't exactly clear what your point was. Maybe you can clarify that. And on China, Larry Lau and I helped Zhu Rongji restructure the People's Bank to decentralize it along Fed lines. And when Georgie Swan was governor of the People's Bank, and they seem to be happy with that for a while, but that seems to have receded as everything's been re-centralized in Beijing. But this got rid of the problem of the party telling the People's Shoe Factory of Tianjin to hire 10,000 more workers they didn't need, and then forcing the banks to lend them the money to pay for it. So a question about what's going on that centralization versus decentralization within the structure of the People's Bank. And then on Argentina, I had an experience trying to help them a little bit with their price statistics. And then Mrs. Kirchner decided that she wanted to get rid of the statisticians. So I'm just wondering if you want to talk about the most fundamental structural thing, it might be useful to think about how you actually have an independent statistical agency as well as independent central bank. And so if you have any comments about that and any progress that could be made on that score, I'd appreciate it.
Thank you. A great panel. I have 2 questions related actually to Milton Friedman and Latin America. Of course, Milton would have favored and did favor a long time ago dollarization for Argentina, but apparently right now it's off the table, and it has been replaced by the 2% crawling peg that Emilio mentioned. We've seen this movie before many times, and in Latin America we called it the little table, big table, tablita, because it announces the rate of exchange going forward. And every one of those experiments failed, and they failed big time. Now, Milton, in his volume Monetary Mischief, has a paper where he compares Chile and Israel, and he gives good grades to Israel because it did have an exit strategy. I think it was Michael Bruno who was running the central bank in Israel at the time. So the question is whether Argentina will have the right strategy to exit from that 2% crawling peg, and if doing so, will still maintain some kind of anchor and a reduction in expectations. And the second question I have, also related to Milton, I was fascinated by Juan Pablo's 4 different eras, the 4 periods. The second period is, of course, the most awful one, up to 74, or starts in 74. And my question is do you think that the love affair between Argentina and indexation was in a way behind that? And Milton was in favor of indexation. He went to Brazil in the early 1970s and comes back and writes a number of papers, and also in his podcast or tapes at the time, he talks about indexation in a positive way. And so the question is, what is Argentina doing about indexations? Once you have a fully indexed economy, it's very easy for the anchor to go away and for inflation to get out of hand.
So Emilio, why don't you go first, and Juan Pablo, and we'll just work our way back to Ross.
So, the first question about the price statistics, I'm not so worried about official price statistics now, because given what happened with the Kirchners and the tamper with statistics, there's a whole bunch of private outfits that provides price information. So nobody, when the government starts tampering with official statistics, nobody pays attention to official statistics. So I'm not so worried. There's the $1 billion project out of MIT with Alberto Cavallo. And so we have very accurate price information now. And fortunately, the official agency that tracks prices right now is run very professionally. So the tampering, and that was a strategy. You know? We can reduce inflation by simply lying about what, but that strategy was very short-lived. The people who are in charge are facing judicial prosecution. So I'm not terribly concerned about that issue at the moment.
Juan Pablo?
Okay, I fully agree with that. So why Argentina? I don't know. Because I'm going to relate it to the indexation question in the past for Sebastian. I don't think indexation was a problem. It was addiction to deficit, printing money, and inflation. That's the simple story of Argentina. That kind of changed in the early 90s. And I'm going to try to give an answer. Why Argentina didn't learn the lesson? There's essentially, in the 90s, actually, there was one country that went below the US. That was Argentina. So the stabilization was cold turkey, and it was extremely successful, and it was extremely popular. To the point that in 1998, when there was an election, the two main candidates started saying, we're not going to touch the convertibility. I even have a picture of myself with a T-shirt from my alma mater in the northwest of Argentina, in front of, together with a huge stone that was painted in white, that was saying the name of the candidate for mayor in the town of 40,000 people that I was going through, sorry, 4,000 people that I was going through, and below that it was saying 1 peso equal to $1. So that was like the Argentinian society embraced that full force. Sorry, this is my interpretation. Then what happened is that the whole experiment failed, and it failed amidst a very strong sense within Argentinians that in spite of a lot of efforts, it had not been helped by the IMF. I kind of share partly that sense. But then that completely changed the mind of the median voter. And the median voter in Argentina went completely different than the rest of the region. So my sense is, if we could have survived that crisis, that was not easy, but if we could have done it, probably the convertibility would still be alive today. Because as the dollarization in Ecuador, nobody would even dare to remove it, unless it was in the middle of chaos as it happened. So I think it just, that at least made Argentina go back to primary school, and now we went to primary school again, and we'll see whether we learn the lesson now. Is dollarization out of the table? I don't know. I think that what they're doing now is try to control the storm, and I haven't seen any sign of a formal plan for the future. They're just going day by day. It's like you're an alcoholic, you go to treatment, one day at a time.
Zhiguo?
Yeah, sorry, my apologies, because Michael asked a question before, and I didn't say anything. But I think very briefly, when we look at Argentina's history, whenever we look at the monetary regime, and as you pointed out, Argentina had a very successful experience from 1900 until about 1930, Actually, most people here are not going to believe this, but if you go back to 1910, right before the First World War, the Argentine peso was considered one of the strongest currencies in the world. So we had periods of stability. I mean, if we look at 200 years of monetary history that go back to 1822, we had roughly between 50 and 60 years of price stability. The interesting thing is the years of price stability that lasted for more than a couple of years, because it's very easy to get price stability for a couple of years and then go back to your old ways. We had full convertibility, either with gold or with the dollar. But you have to superimpose on the monetary regime another type of regime, which is the populist regime. And the populist regime is about going too crazy on the on fiscal profligacy and expanding public spending, etc. So you cannot you cannot understand the story of Argentina and the inflation story of Argentina if you don't understand the populist story. So we like to think about what we know about, which is the monetary thing, the macro thing, but there's something else going on, and that's populism that emerged in Argentina in 1945. And that was critical. And since then, there's no other country in the world that has embraced populism with such passion as Argentina, despite the horrendous results that populism delivered. And so now that would take us into sociology and psychology and all sorts of things that have nothing to do with this conference. So that's my 2 cents on your question.
Okay, Zhiguo.
I'm gonna be quick. So I really want to mention in China that the regulatory and then the monetary policy part is separate. The other part is called a China Banking Regulatory Commission. You probably heard about it. And I want to say that if you separate them, it's not a guarantee that they're transparent, right? It's just you have different parts, and the regulatory part actually is way more complicated, way more non-transparent than the PBC, and it's connected to my answer to the question about the centralization. Centralization obviously is happening. Most of them actually is shifting power from PBC to CBIRC that I was talking about, because for them, a lot of the central order can easily transmitted through the regulatory system.
Ross.
Okay, so on the capital or any type of explicit regulation, yes, those can be definitely written down. So my focus here is really much more on supervision and the discretionary power to interpret that. And I think that tends to be definitive in terms of what actually goes on in shaping bank behavior. So I'm not getting Darryl Duffy, you have advanced things on liquidity requirements, and all of that that's fine. It's the discretionary part. On the independence of banks, the independence of the supervisory entity from banks, I could not agree with you more, Paola, and I'm sorry I didn't mention it in my remarks. I was focusing, kind of building on what the IMF said, but yeah, I completely agree. On responding to Michael about what to do, so I wrote a book on this and wanted to raise the concern that how can it be in a democratic society that we've allocated so much discretionary influence over the allocation of resources to an entity outside of the democratic process? So I want to raise that concern for people to consider. I then made maybe the mistake of proposing a suggestion of how to address it. And then everything about the book became a critique of my recommendation, as opposed to getting more innovative people to deal with this challenge. So I'm happy to articulate that, but not right now. And yeah, that's it.
So we are technically over time, but since the last session ran over and we are still within an hour and 15 minutes, I'm going to take the moderator's privilege to take 3 quick questions. Bob Hall, John Cochran, and the person who's traveled the farthest to get to the conference, Emilio Ocampo. So please be quick, and then we'll wrap it up.
Okay, this is Bob Hall. So in the wrap-up of Latin American countries, it seems to me Chile didn't get full credit for its system because it has a secondary stabilized currency, and large volumes of transactions occur through the Unidad de Fomento, which is defined to be enough Chilean pesos to buy the cost of living bundle, so therefore it's completely inflation proof. But they don't get any credit for that, in spite of the fact that large amounts of transactions are priced that way.
Primarily for Juan Pablo, but the rest, you left an impression that I don't think you mean to leave, that Latin America, all it needed was the central banks to wake up and say, oh, we should target 2% inflation, and that cured inflation. I remember you wrote a book, and there I got more of an impression, my stylized version of all history, is that successful disinflations combine monetary, fiscal, and microeconomic reforms. And I'm sure that was part of the story you meant. And related for the panel, you left the impression that inflation in the COVID era came from central banks lowering interest rates. Well, we had 0 interest rates for 10 years. That didn't set off inflation. Japan for 30, that didn't set off inflation. So I'm sure you didn't mean to leave that impression either.
Thank you, Senator Cochran. Over to Amir.
Thank you, Peter. Amir Yaron. Ross, just I guess you made the premise as if monetary policy is easy to evaluate how good it is, whereas supervision is really hard. I would kind of challenge a little bit how easy, even exposed, to do that. But regarding, it is true that a fragile banking system would really harm ability of monetary policy, but you know, there's about 50% of the central banks don't have bank supervision. You take Australia, Canada, EBA in Europe. So it's not the necessary issue. And the tension often is between stability, or what's called prudential versus conduct, or competition. And that is always an issue. And when the real value often in the supervision, and it comes being close to the central bank, and we saw that happen in the UK when before 2008 they moved it out from the central bank, and then after 2008 they moved it back in, is the information and soft information between the regulator and the banks. And banks are a different animal than other, because of leverage, because of other entities. So when it comes to the touchy issue of lender of last resort, that's when you want them to have the contact, and then that's where it's particularly valuable.
Okay, presenters, if you would like to respond, please do so in no more than a minute.
Yeah, very briefly, the Unidad de Fomento in Chile, probably knows much more, Sebastian, but it was done when inflation was high, and it's still used today. So I mean, it's just essentially a way of indexing contracts of different types, and it worked really well. Thanks, John. I never meant to suggest that they was they just read the book on inflation targeting and they started doing it. Actually, it was in '82 when I learned that inflation was created by money growth, and I was amazed. And I told my professor, "Why don't we call the central bank and tell them?" No, absolutely. Fiscal consolidation happened starting in the middle of the '80s, and most countries kept it, and that's the reason why inflation is low now in the 9 out of 11.
Zhiguo, Ross, anything?
I guess maybe focusing on turning to the U.S. I'm not so sure how great that information sharing was. In 2021, when I was interviewing to come to Hoover, at the very end of that, there was a dinner with Amit Saru, and we got into an argument. And I said, look, inflation is running high, they're going to have to tighten monetary policy. And Amit said, oh no, I've been doing all of this work on banking. If they do that, given duration risk in banking, a large proportion of the banking system is going to go bankrupt. There's no way they're going to increase interest rates. And unfortunately, we were both right. And so there was not the supervision and regulation and sharing of information of the type that I think we both agree would be helpful. So it's not so much to pull necessarily to pull supervision regulation out of the central bank, but it is to have some entity with the capability to do an objective assessment of what's going on with supervision and regulation. Nobody can monitor what the Fed is actually doing. And while academics, a collective group of academics focused on that could do it, lots of independent academics, I don't think can do it very effectively.
So with that, let me just recognize that we are under the hour and 15-minute Taylor rule, and please join me in thanking the presenters.